The new Income Tax Bill 2025 includes a subtle but significant change, which is removal of Nil TDS certificates. This happens because of deletion of just two words, no deduction, from the language of the bill. So let me explain what this means. Now currently, if your actual income tax liability is zero, but TDS is being deducted on your income, you can apply for a Nil TDS certificate. When granted, no TDS is deducted on your payments. But under the new bill, while you can still apply for a lower TDS certificate, the complete exemption from TDS through a Nil certificate will no longer be possible. So why is it relevant for NRIs? Before I jump to that, if you are watching this video for the first time, I am Alok. I am a certified financial planner and managing partner here at Prime Wealth. When you sell a property in India as an NRI, you are subject to TDS rates of 12.5% plus some surcharge and cess as per the new Income Tax Act, which is compared to just 1% in case of residents. Now currently, if you have no tax liability, perhaps due to the indexation benefit or because you are reinvesting the money into capital gains, you can apply for a Nil TDS certificate and avoid any kind of TDS deduction upfront. Now with this change, even if you have zero tax liability, some amount of TDS will still be deducted. This means that a significant portion of your funds will be locked up to until you file your income tax return and claim a refund for it. So for perspective, if you are selling a property, let's say around 1 crore, instead of receiving the full amount, you might have 12 to 15 lakh rupees withheld as TDS, even if your actual tax liability might be somewhere close to zero. So let me break down how this will exactly impact in various situations. See, if you're selling a property at a loss or minimal gains due to indexation benefits, or let's say if you don't avail indexation benefit, which NRIs can't, you will still face TDS deduction. Now, for instance, if you purchased a property years ago and you're selling it now with minimal gains, you still need to pay TDS and wait for the additional money to get refunded later. Now, many NRIs who sell property in India to reinvest in another property, which can provide exemption from capital gain tax. Now, without a Nil TDS certificate, you will first need to pay the TDS, then claim a refund after proving the reinvestment into property, which is basically you are getting affected with your liquidity in terms of your new purchase of the property. Also, if you own a property in India that generates a rental income, you will now have to plan for some TDS deduction even if your total income falls below the taxable threshold due to the deductions and various other factors. But there is some positive aspect to this change also. The new bill allows NRIs to apply for lower TDS certificate across all types of payments, which wasn't the case earlier. Now, there are experts who suggest that this simplifies tax compliance as you can potentially benefit from lower TDS on diverse income sources like your rental income, your dividend, or your capital gains also in many cases. Now, we think that the tax department might adopt some kind of practical approach, like allowing very small rates of deduction on TDS for NRIs like 1% in cases where previously they would have applied for a Nil certificate. While these small amounts wouldn't significantly affect your liquidity, they would fulfill the government's requirement to be able to keep the check on any transaction which is happening. Another option is to build a mechanism where NRIs can claim that additional TDS paid back as a refund immediately within a month or so, when they actually don't have to wait till the year end to do the filing and get the refund. So we need to understand that without a TDS deduction, there is no reporting of the income either. Now, this data gap is likely why the government is moving away from the Nil TDS certificate, as many people would have misused it. The focus seems to be collecting very less amount of taxes and more keeping all your income trail visible. So, as your financial advisor who is dedicated to help NRIs navigate these complex financial tax landscapes, I recommend that you do the following things. First is review your upcoming transaction in India and assess how this change might impact you. Second is make sure that you consult a professional to apply for any kind of lower TDS certificate, not only to properties but for your other income sources also if applicable. And the third is to build the potential TDS deduction in your financial planning so that you can do your transaction timely, so that you don't have to wait for refunds for an entire year. So if you are planning any significant property transactions or new investments in India, now is the time to properly think of and get some advice about it. Remember that staying informed and planning ahead is the key to these changes successfully. If you found this video helpful, don't forget to hit that subscribe button and join my NRI only WhatsApp community, for which the link is in the description below. Thank you, and I'll see you in the next.